Hello everyone, welcome to the Cognitive Living Room. Welcome to the stock market, the secret of trading part 2. Here I will help, entertain and educate you how to be a better trader and investor. If you are new here in the Cognitive Living Room, make sure you click on the subscribe button and all the links we mentioned in this video. My name is Attila Németi and our topic today is the fundamental indicators. So let's jump into it. Do you like the beach? Do you like the ocean? The stock market is like surfing. You wake up at 5 in the morning, drink your coffee, check the water, wind and tide conditions, put on your best swimsuit, pick up your best surfboard, head to the beach and jump into the water. Flowing on the surface of the water, slowly paddling with your hands on the top of your surfboard, searching for waves to come. After a couple of ripples pass by, finally a 6 feet tall, large wave is rushing towards you quietly, fast and powerful. As the wave reaches you, you take a big breath, you hold onto the board with both hands, turn your board, and without any hesitation, you quickly jump on it with both feet. The water lifts you high, and with the joy of freedom, you happily ride the wave to the shore. How long you ride with the wave depends on the power of the water and on your skill and talent of surfing. The secret of trading in the stock market, as I explained to you in an earlier webinar, is science and art. Science to enter in the position of a stock, art is how to get out of the stock. Today, we will talk about the science part, how to enter into a stock with a guide, specifically the fundamental indicators. Okay, I have a question for you. What do you think? Which sector of the market is the most actively traded in 24 hours? Is it the New York Stock Exchange? Is it the commodity exchange? Is it the option exchange? What do you think? Guess what? It's neither. If you believe it or not, it's the currency market. It trades on average of more than $5 trillion every day. $5 trillion. Would you believe it? Every day. That means someone gains $2.5 trillion and someone loses $2.5 trillion every single day. But today, we will not focus on the currency market, we will focus on the fundamental indicators, the science behind how to enter a position. On the first webinar, we talked about that you can trade 7 different fundamental ways. These 7 fundamentals that move the stocks are: number 1, the trend and the direction of the market. Number 2, performance. How is the stock doing? Number 3, buying and selling volume. Number 4, momentum or the lack of the momentum. Number 5, economy of the stock. Number 6, volatility. Number 7, the psychology of trading, especially the fear and the greed. Oh, just a reminder. For many of you, to step into the world of Wall Street is a brand new entity, so if you don't understand something, I speak too fast or my accent is too weird, you are more than welcome to stop the video and type a question in the comment section. Make a note or rewind the video and watch it again. Please don't forget, information leads to knowledge. Scientia potestas est. Knowledge is power, as the Latin says. So, let's continue. Alright. So let's look at the first of the 7 fundamentals. Number 1, the trend and the direction of the market. The stock market, just like the price of individual stocks, tends to trend. Indexes are prone to move in one general direction or another until something causes that direction to change. You can tell in 4 different ways if a stock or an index is an uptrend. Number 1, search in a stock for higher highs and the higher lows. Number 2, Look for stocks that trades over the 50-day moving average, and look for stock that the 50-day moving average is above the 200-day moving average. In that case, the uptrend is even stronger. Number 3, look for a stock that's RSI, Relative Strength Index, is above 70 for a longer period of time. The RSI 14, I set it up for 14 days. That helps me, or that is the number that I like. When the RSI is over 70, it means the stock is in an overbought level, but if it stays there for a while, the stock is in uptrend position. And number 4, the fourth way to recognize an uptrend, called the 3-line break indicator. One green candle is 150% taller than the previous 3 red candles combined. This candle is a Japanese candlestick market I am referring to, and that is a different lesson or webinar that I will teach just about the Japanese candlesticks. And that is the reverse indicator into an uptrend. The second fundamental way to trade a stock, by its performance. By its performance of a stock, it's 8 different ways you can tell if the stock is worth to buy or not. These 8 different ways: 1. Price, revenue growth, earnings per share, dividend, market capitalization, analysis report, industry, and major economic indicators. Let's talk about the number 1 of the price. The price of the stock only be viewed in context. How much will it cost you to buy a share of this company? The price will determine how many shares you can purchase with the money you have. Evaluating a stock, knowing the price of share, their history, will determine if you are getting a good value when you are buying it or not. Number 2, revenue growth. Stock prices generally rise if the company grows by increasing its revenue. You should use this indicator as you're looking into revenues quarter by quarter and year by year. Number 3, earnings per share or EPS. To calculate the EPS of the stock, you take the net income of the company at the end of the quarter and divide it by the outstanding number of shares of the stock. For example, if the net income is, let's say, $634,000 and the outstanding shares are 800,000, the EPS is 79 cents. The higher the EPS, the better shape the company is in. Dividends are popular to long-term investors as they're looking for an additional income. Many companies do not pay dividends because they prefer to reinvest their cash back into the company. Many companies return their portion of their earnings to shareholders, and the investors can receive a small payment for every share they own. It's easy to search for companies with the highest dividends. Number 5 is market capitalization. The market cap is calculated by multiplying the price of the stock by its total number of outstanding shares. If a company with 20 million shares selling at $50, the market cap is equals with $1 billion. I never invest in companies that has less than $1 billion market cap. With the higher the market cap of a stock, the less of its volatility. So for an investor, the market cap is one good indicator. The 6th one is the analysis report. Many brokerage firms and investment banks have research analysis that issues reports and recommendations of individual stocks, often with buy or sell ratings. What you should know about these reports is that the expert's opinion is not more reliable than the proverbial dart-throwing chimp. Number 7 is industry. It's important to examine not just the individual stock, but the sector too, where the company operates in. For example, when you're targeting Boeing, you should check out the airline sector to understand how the Americans are traveling. Looking at the stock in this context will help you understand if there are positive or negative influences reflecting the company's share price. The 8th, the major economic indicators. The stock market and the economy link to each other. The world's and the nation's economy, if you like it or not, plays a major role of the stock share performance. These are like unemployment rate, consumer prices, changes of interest rates. Now with this one, we finished all of the 8 performance indicators. The third fundamental ways to trade a stock is buying and selling volume. A high trading volume is a strong indicator that the market is healthy and traders are interested to buy and sell. The low trading volume can induce volatility that both positively and negatively affects current pricing of the stock. Each stock, each sector, each indexes and the market on its own has a daily average volume that you can compare to each other. The ask volume is the buying volume. The bid volume is the selling volume. Higher the volume of the stock, the smaller the gap between the ask and the bid. The fourth fundamental trading is the momentum trading. Momentum is general, refers to the price to trend. The momentum indicators show trend by remaining positive while an uptrend sustained, or negative while a downtrend sustained by showing the difference between today's closing price and the close X days ago. The fifth fundamental trading is economy of the stock that could be internal or external. Internal economic indicators: supply and demand of their product, revenue, cash flow, price-earning ratio, earning per share or EPS. External economic indicators are interest rates, gross domestic product, existing home sale, unemployment, and government regulations. The sixth fundamental indicator is volatility. Volatility is one of the most misunderstood concepts in investing. So, what is volatility? Simply put, volatility is a range of price change in security over a given period of time. If the price of the stock stays stable, the stock has low volatility. If the stock hits new highs or lows quickly, moves erratically, has rapid increases and falls, the stock highly volatile. So, what causes stock to volatility? It could be the result from an imbalance of trade orders in one direction, for example, all buys and no sells, or all sells and no buys. And that could cause by things like company news, analysis recommendation, upgrades, downgrades, initial public offering, or unexpected earnings results. The seventh fundamental trading is the psychology of trading, specifically greed and fear. A big mistake that beginner traders make is to assume that using technical and fundamental indicators alone will allow them to become successful. Big mistake. In fact, learning to control emotions is the most important skill to become successful because emotions have the biggest impact on your results. Greed is one of that emotions. Greed can be thought of as an excessive desire for wealth, so excessive that it clouds rationality and judgment at times. This includes making high-risk trades like buying stocks or indexes without researching the underlying investment. Fear, on the other hand, causes investors to close out positions prematurely. Fear is a potent emotion that can cause investors to act irrationally in their haste to exit the market. Fear often morphs into panic, which generally causes significant sell-offs in the market. That's it for today, folks. If you liked our webinar, don't forget to push the subscribe button so we can notify you when our next video is coming out. In our next webinar, we will talk about the psychology of trading. Hope to see you there. Strength and honor, I'm Spartacus.